Hey folks, thanks for tuning in. Josh Pinney-Levy here with Real Change Financial. I want to go over a very practical example of the infinite banking concept. We always say infinite banking, IBC, acquire an IBC whole life policy, become your own banker, just like Nelson Nash's book, Becoming Your Own Banker. Becoming because it's a process. But what does that mean practically? So a very common example, which should be and could be tailored for every single person interested, is how do I consolidate my commercial loans utilizing my policy, utilizing my bank? Well, I'm going to run through a real example that we ran for a client, and then he executed. He took this loan and consolidated a commercial vehicle loan. So this is a $50,000 secondhand truck, 11%. That's what the dealer came up with for that great price. Now the client had in mind that he would be consolidating this loan with IBC, but to get it on the spot, he took that financing. Dealer said, the 5-year price is a little bit over $1,000 a month. So he ran 7 years. 7 years was $856 a month, and the client said, I can afford that. Which is, think about it, all of our decisions are based on, can I afford that in my monthly budget? So to which I like to ask, Mr. Client, how many of those payments did you expect to skip? Will you pay them all, or are you going to skip any? The answer is going to come back, hey, I'm going to pay them all, or else it's going to be a negative credit outcome to my credit score, or they'll repo the car at the worst case scenario. So nobody is going into a loan agreement planning to skip payments, and that's going to be critical, because when Nelson Nash in his book Becoming Your Own Banker says don't steal the peas, classic example of he uses it as a joke line, but it's developing a habit. Don't steal from yourself. Don't steal from your bank. If you're going to take a loan, pay it back. If you're consolidating a loan where you're going to pay $856 a month for 7 years, pay $856 a month for 7 years. What does that look like? So delving deeper into the loan itself, that's $71,914 that will be paid back over 7 years. Easy math. The interest is $22,000, $21,914. Divide the interest by the total cash flow that went out of your pocket, and that's 30%. So again, as Nelson says, know the rate and know the volume and know what the difference is. The rate is 11%. That doesn't sound too bad. But if someone came and said, you're paying 30% interest by volume, ouch. How can we do better with a policy loan? So we don't walk to the life insurance policy. We take out $50,000 now. This individual has that much money to take out of the bank, his policy loan. You could either build a policy that has that much cash value, see your agent, see us, look below, give us a call, contact us. Or you can wait till that builds up over time. Either way, the iron was hot, so we struck. He took that $50,000. First, he checked if there was any early payment fees involved with the dealership. Your mileage may vary. It's something you should check into. And he paid off that loan. Now, immediately, his income to debt ratio, if he changed nothing else, should go up. It should go up because there's $50,000 of secured debt off of his credit score. Their credit reporting agencies won't see it anymore. That's a good thing if he cares about credit repair or maintaining the highest credit possible. Secondly, there's no new debt going on there because this is completely private. Can't be overstated that life insurance and infinite banking are, you might call them libertarian in nature. It's private contracting between individuals, but the government has no say or visibility into what you're doing with your money. We're just taking a personal loan and we owe that money back. There's no tax consequence at all, and it's invisible on your credit score. And he's going to continue to make those same $856 payments. I actually graphed out 7 years of payments. Now, each payment is going to go entirely against the principal. You might be used to hearing that every payment on a loan is going to be part interest and part principal. And of course, in the earlier years, an amortized loan is going to be much more interest than principal. Not the case with a life insurance policy loan. Every dollar is reducing the principal by $856. Until the end of the first year, there's $40,582 left to repay. Consequently, he's going to get an interest bill, because interest is still accruing, but it's dropping every month because the principal's dropping every month. Interest is always principal times the interest rate. Here I'm showing 5.02%. That's the life insurance company this individual is with. And dividing by 12 to show the monthly rate or the monthly amount. Sum total $2,273 at the end of the year. Now, he's going to get a statement and say, hey, I thought I'm paying already. He might not. He's very with it, but we don't always have our mind in infinite banking. Your agent really should. And I would advise him, hey, if you have the cash flow, you can pay that, but still make your monthly payments. If you don't have the cash flow, well, we're graphing the worst case scenario, roll it into the next year's, in the very next month 13's principal. And that's what we show here. But we're going to continue making payments. Now, we're in the red until month 68 of this loan, and there's $124 left to pay. He makes his payment, and now he has a surplus. The loan is gone, and he has a decision to make. You told me you weren't going to skip payments, so you can either save, all right? That loan cost me less for my cash flow, or, what is the old game show? Let it ride. And he keeps paying until the full 84 months, 7 years is up. What does he then have? Well, he could have paid $22,000 in interest to the dealership, or here a surplus of $13,500, or to be really exact, since he paid the first month already to the dealership, $12,700 in what looks here like an overpayment, but for him it's profit that otherwise would have been interest in somebody else's banking system. And it's not just $12,000 in that 7th year going into his policy extra. It's $12,000 that'll earn compound interest year after year after that. So pay $22,000 to somebody else's bank, or put 12 to 13 grand in your own bank. And what's more, besides the credit implications, which were none, except a better credit score at the outset of this loan, that $50,000 with the proper company designed the right way is not recognized by the life insurance company as a debit in any way. So he's still earning interest on it as if he hasn't taken out any money. You can't find that with any other type of account or system. His money is earning interest. His money acquired a car. And his money, which we don't show here, is backing up a very large death benefit for his family. So that's infinite banking in a nutshell, and it's always better when you are the bank. If you like what you saw today, please like and subscribe for future videos.